Hello again. This is Josh Carr with The Real Angle, and today I'm speaking with Erin O'Boyle, founding and managing partner of Harvest Capital Partners. Erin, how are you doing today?
Good, Josh. Thanks for having me.
Good. Thanks for joining. Always a pleasure to chit chat a little bit. So I always like to start with the very basic stuff. Harvest's website is what's your web address?
www.harvestcp.com.
Always like to say that early on because invariably the first thing anyone does on their phone is try to figure out who is this Aaron person and who is Harvest. So let's start by talking a little bit about Harvest and what is Harvest. I guess let's start from there. What is Harvest Capital Partners?
Sure. So Harvest Capital Partners is an SEC registered investment advisor, and we're also a minority women owned business. And we advise institutions, including public pension funds, corporate pension funds, family offices, and the like, on their real estate holdings and strategies. And we offer comprehensive services to our clients.
Okay, so there's a few things there to unpack. Let's start with I guess what is an SEC registered advisor? What does that actually mean?
An SEC registered advisor means you go through the formal process of being registered with the SEC and complying to all of the rules and regulations. The bottom line is they're just trying to make sure you're being a fiduciary on behalf of the investors you represent. There's not conflict of interest, there's not separate agendas. So it requires a lot of compliance with regulations like Dodd-Frank from the last recession,
Sure.
um, pay for play, reporting standards. You have to have a policies and procedure manual. And it sounds like a lot of administration, but at the heart of it, if you're representing an institution that's, let's say, a pension fund that's representing, the school teachers and firefighters from your community, you want to make sure the person advising the pension fund is really a fiduciary. So it takes a lot of work, but it is a kind of the gold stamp of approval in some ways. And many institutions require that as part of your advisory work.
Right, and you mentioned pension funds. I mean, often pension funds internally, I mean, it's not that they don't have investment professionals, but at the same time, they're just a pension fund. Like they
Well,
often need external advice.
yeah, and they often have very small staffs. I don't know if that's disseminated by the public. So they have very small staffs to invest, ongoing large pension funds or endowments. So they find a way to do so effectively because they don't, they're not set up to be a large investing organization.
Right, and they're sitting on piles of money, and often, at least in my experience, I mean, yeah, I mean, as you said, I mean, they're representing, groups of people who are not necessarily investment professionals, like school teachers. So someone needs to look out for them. No, and that makes
Right.
a lot of sense. I'd imagine also, just big picture, the fact that you're SEC registered means that when you speak to other entities who may not necessarily be required to use an SEC registered advisor, I'd imagine that also gives some comfort when you talk to other entities just because, you know, they just figure, hey, if the feds, you know, did the paperwork,
Right.
gives a comfort.
It is a acknowledged credential. And what we've done in our practice is prior to forming this, we had, over 25 years of experience as a principal. So
Sure.
we bring a real informed knowledge and experience in the business. In my career tenure, I started working for a major developer, developing office and retail buildings with a major regional developer. Then I ran asset management and portfolio management for an office, industrial, and hotel portfolio. Then I did a slew of workouts. I'm showing my old age through the last cycles,
Sure. Sure.
in which everyone participated.
Yep.
Then I worked also as head of investments for a public REIT, so experiencing the requirements of that. Then I was one of the founding partners of Beacon Capital Partners, where I was chief investment officer. And so we were at the beginning of the whole wave of private equity in commercial real estate. I formed an investment platform with Prudential and an exclusive joint venture. So I mention that because what we bring to the consulting is all of that principal knowledge. So it's a little different than some consultants. And I always laugh. I have a client who I'll say, well, what do you think of this business model? And he said, well, he says, I'll be honest with you. He says, I don't know anyone else who does what you do. So we have found we've been able to really service clients in that regard. And, we're just delighted to be able to help them with anything in their portfolio.
Well, and the fact that you're coming from more the principal side, I mean, you started, when did you start Harvest? When did you set this up?
2004. So it's been 20 years.
Right. But before that, the fact that you came from the principal side, I think is really valuable because, I mean, the use of the word consultants is always dangerous. I'm always amused when I look at some of the big name consulting firms, the Accentures of the world. I mean, not to beat up on Accenture here, but when I think about the big name consulting firms, and they seem to be legendary for, they hire fresh-faced kids out of B school, and they say, hey, you're 25, go advise someone with 40 years of industry experience, and that's lunacy. I mean, I'm not saying you
Yeah.
shouldn't listen to
No,
voices of the
and
young, but still, you know.
you hit the nail on the head because um there are because we've been a general partner in the REIT, we understand what the motivations, what the strength and weaknesses are of that structure. We know from being in private equity that it's a momentum business in which you need to invest and monetize your investments within 4 years or so to be able to provide those net returns. We
You've got
know
your
from being a
window. Yeah.
developer. So
Right.
it's
Right.
been kind of good. And the range of what we offer, we can give investment recommendations, we can do asset management, we can do workouts, leverage
Yeah.
strategy,
Yeah. So let's
JV
talk.
negotiations.
I was going to say, so service wise. So, I mean, basically, the pension fund comes to you and says, I imagine, first off, these are the assets we already own. And then possibly these are assets we're looking at. And so you're providing asset management and acquisition support, if you will. Right.
Yeah, and sometimes I just called it's like we're a chief investment officer for hire.
Got it.
And it
Got it.
covers a lot of ground for them. And then, you get into what their goals and objectives are and then tailor whatever your solution is to what their needs are.
And to their obligations, because they got to, if they're a pension fund, they got to pay out X amount of dollars a year for, pensions. So, no, it's interesting. So, when you're, I guess let's talk a little bit about the institutional mindset, which is a phrase that gets thrown around quite a bit. I mean, are there, I mean, I imagine it's true, but like when an institution is thinking about where they want to deploy capital, like are there times where you've come across investments or concepts which you feel objectively are a good idea, but because of, for lack of a better word, mindset, tradition, culture, history, the pension fund just can't play in that space?
Yeah.
Are,
I'd like to demystify that because I work with
please.
some GPs that, as you're highlighting, it's kind of a little bit of a mystery. So first, I'd say there's always great deals out there. You can make money in any part of the cycle. It's just connecting with the capital that fits you. So, to your point about pension funds, they have a whole series of requirements and a policy that really guides what they do. A simple way to demystify it, if you want to know what a public pension fund is, just click on, find their investment policy. It'll tell you we want to allocate to these sectors, we want to allocate to these geographies. We maybe don't want to have leverage, or no, we'd really like to have leverage and have enhanced returns. That will demystify it. But they have some have very large blocks of capital to deploy. Like if you take like a CalSTRS, one of the largest pension funds in the
The
United
mammoth.
States,
Sure.
they have to invest in large blocks. So they're looking for efficiency, they're looking for diversification and whatnot. The corporate pension funds have a similar approach, except it's obviously private. And then you have just some institutional investors who have developed their own strategy and profile. And then you would work through understanding that by speaking to them. So I understand particularly the GPs feeling what is it that they look for, and they really are different, and they're looking for track record too. They just don't want to do that one deal with Josh Carr
Right.
that's a home run. As much as that'd be great, they really want sustained performance over a long
And they
term.
want a pipeline. If we're going to go through the aggravation of we're going to build these documents and do this deal, then let's do five more. No,
Right,
it's
right.
it's interesting. On the consulting side, I've been involved in helping some money manager types basically say, "Hey, I've got the local developer, I've got the pension funds over here, and I'm sitting in the middle and helping them allocate that money." And I've worked with those managers, and yeah, I mean, it's the guidance and it's the pipeline and it's the saying, let's get paperwork in place so we're not just doing one deal, we're doing 10 deals. But I just wanted to address that. I mean, I had a conversation recently with someone who's a specialty lender in the farm industry. They lend to farmers, that's their whole thing, and they do wheat and corn and all that sort of stuff. And during conversation, I said to him, "So, what about cannabis? Cannabis is a real field." And he's like, "Well, our warehouse lines and our financial partners just philosophically won't do cannabis." And I'm like, "Okay, well, what about hemp? Because that's the cannabis that doesn't get you high." And he said, "Well, same thing. They're terrified that we'll do hemp, and then accidentally, cannabis will sneak its way in because plants are going to do what plants are going to do. So, just no, And that to me is sort of the speaks to that institutional mindset of we have a strategy, we have a plan, we have our risks, and there's only so much we can do. No, that's interesting. That's interesting. So, you know, obviously in today's market, things have gotten, shall we say, interesting. Interest rates have spiked. Whether or not they keep going and they stabilize, we'll see. How is that affecting the conversations you're having with some of your clients?
Well, I'd say a lot of capital is on the sidelines, right? If you are institutional capital, it is not worth the risk sometimes to enter the market while there's a falling knife. And you want to wait till it settles out a bit. You don't need to be the first mover in the space. But as we've seen through the cycles, it's the capital markets volatility that has the biggest impact on real estate. And, that has, in some ways, Josh, it's not a surprise at all. If we look back over our shoulder, the last 10, 15 years of these low interest rates were an anomaly. I mean, I don't think we had rates like that since the 1950s. So,
Right.
um, as one colleague said to me that I find humorous about the investment market through that time, the pie eating contest is over. You could invest at a small spread to treasuries and make money. Now it's going to require a lot of skill, and the returns that we're seeing to be an appropriate spread to treasuries, whether it be 100 to 150 basis points for multifamily or 250 for office, um, those are more going back to historic cap rates. And so it's a tricky time. Office, particularly with the work from home, has forever changed that sector.
Yeah, no,
Um,
it's funny you mentioned that because I've done a number of interviews, and a the majority of the calls I've done, the person is in their house, the majority, and I'm sure if I had been doing a call-in show or something like this, 20, 30 years ago, that would have been 1 in 50, and he or she would have apologized for, well, I'm sorry I had to take the call from home.
yeah.
Um, America has changed, for lack of a better way of putting it. Culture has shifted, and at this point, I don't see any reason it's going to shift back. I
Now,
just
I
don't.
think the consensus of most folks in the industry is we'll go to a 3 to 4 day a week in the long term.
Hmm.
Europe and Asia have gotten back to the office much quicker for very secular, regional reasons. But this appears to be the new model for office. And it's going to be a period of time to recover. So, on the positive side, if you can get some great investment in office through this cycle, there will be very little competition, and there is almost zero financing for office buildings. So,
Yes.
a lot of sellers are going to offer you seller financing. So, I'd keep an eye out for folks who enter it. They need to buy the best in class. There are some very sophisticated operators in that space. I think they'll do well, but that sector has a longer term shakeout over a period of years.
Yeah, no, definitely, and that's great points about that. And even things like retail that everyone thought was going to be the end of the world. It seems to have bounced back. I mean, people still, all those people working from home, they need to go out for lunch too. Like there's still a need for retail. Maybe it's not where it used to be, but there's still a collective need for it.
Yeah.
So I guess for the next, if you were going to make a bet, so to speak, at what point some of these bigger institutions say, okay, now is the time to jump back in the pool? I guess what will be the things that make them jump back in? Will be interest rate stabilizing? Will be we get out of an election year? Does that even enter into the conversation? Um, and again, not to get into politics, but people often, whenever things are weird, they say, "Well, it's an election year." Like, do you think that really matters? Like, what do you think it's going to take to get these guys to be like, "Okay, now's the time to deploy"?
I'd say that a few things on that point. First, things would have to stabilize on the interest rates. They've been bouncing up and down a bit, but I think there are many who believe we are still on the cusp of a recession and not the soft landing. So I think that would have to shake out quite a bit. Two, I think the cycle we're in now has a serious loan to value problem, way in excess of the 92 recession, way in excess. And so, where is that going to shake out? There is going to be significant workouts, there's going to be significant loss of capital. So, where those investment points are as you enter a cycle like this, you can't always, really nail it. You want to make sure you're close to the bottom or at the bottom. It's hard to nail, but I think this recessionary overhang and feeling there's actually a great expression I heard
Mm,
that described the status of commercial real estate. And they described it as a time bomb with a fuse of indeterminate length. And
that's an
I
excellent way
think
of putting it. Yeah.
I think that just answers your question. They just want to see where this is going to shake out. And so I think you're going to get some early movers, some rescue capital, some opportunistic funds. They're going to go in. They may say, hey, I'm not at the bottom, but as long as I'm in that quadrant near the bottom, a lot of folks are raising that rescue capital to provide the liquidity for the range of workouts that are happening or are underway.
Right.
So I think that capital will jump in. The conservative institutional capital, I think, is going to be very measured until there are more green shoots out there of stability and on the interest rates. A lot of them have negative leverage right now. No one's talking about it, Josh. If you had an updated valuation based upon discount rates updated to reflect the higher interest rates and cap rates that would reflect the market, it would be a different value than maybe you're carrying and might be negative leverage. So
Right. A lot of these
I don't
assets may actually be insolvent. You might actually be in deep trouble.
so
Yeah.
there's a lot underneath that question that I think there's a lot of risk in the capital stack that's not necessarily being understood.
Yeah.
Institutions do appraisals to understand values, whether they be accurate or somewhat accurate. And then they do audits at the properties to make sure the cash flow is correct.
And they're usually doing that annually, right? Appraisals are done
Both are
like on
done annually.
yeah.
But what is the best practice in place to stress the capital stack? I've asked that question of a number of institutions, so I don't think there is one. Now, folks hold assets in different ways. It could be a separate account, could be direct, could be a fund. But understanding that's important because if the capital stack is now inverted, you need to understand your risk. You need to understand if you have a partner, if have their incentives changed or their motivations changed. And you need to be able to come together to work towards, a solution if there is illiquidity.
Well,
So there's a lot going on that maybe just isn't as spoken about as in as many forums, maybe except for yours.
no, and
And
and it's a
that's impactful.
and it's a fair point. I mean, I think what you're seeing in certain circumstances now even is you may be an LP in a deal and your deal may be fine, but the GP is stressed because of the other deals that the GP has that have blown up. So now you say, well, the GP is downsizing, the GP has operational issues, the GP, in plain English, the GP is firing staff because they just can't make things work anymore. So your deal may be fine, but now what do you do if your GP is basically scrambling for operating capital and is just dysfunctional, you know?
Yeah.
So it's great your deal's fine, but the
Yeah.
GP has got other issues.
So if you were to ask me, what do you think we're going to be doing in the next, 12 months to 3 years?
Right.
Our view right now is that we think an independent review of institutional owners of their properties, given the challenges, would be very worthwhile, regardless of how you hold it. It could be a
Right.
fund, could be a separate account, could be direct, because of what we just spoke about, that values may not be accurately recorded. And then, by the way, if you have leverage, you may have a lender who has debt yield requirements and are asking for a pay down of the loan, which means a funding by the institution. And that funding might not have associated with it the appropriate yield compensation for the underlying risk. New capital should get a higher preferred return because of
Right.
the underlying value. So we think there's that to be understood. As you highlighted, the strength of your GPs or investment managers may be changing. You need to understand that.
Well,
And you may find that depending on the timing of debt held on your assets, you may be approaching a workout because repayment is just not possible. And there needs to be a way to bring people together in a realistic way, just like, the last three recessions. My team, we've been through three workout cycles. You need to have the experience to be able to bring them together, be realistic, because for a lender, taking it back, not only is there adverse tax consequences to GPs, but also they can lose 20% of the value just by taking an asset back.
right, because now it's a workout, it's a distressed asset that never sells what it should, et cetera. And by the way,
So,
not to call back to a comment you made earlier, but when you talked about loan to values and where we are vis-a-vis its relationship to the 92 recession, for those of you who are listening, 92 was bad. So I mean, it's, to say that it's worse than 92, that's not a flippant statement, because I think, people who were playing in this industry in the 90s, that was a challenging time. A lot of big name entities that no one imagined would failed. So here we are, and
it's
we're
very similar because there was no liquidity then, just as you highlighted, Josh. There's none now. There was none then. Here's kind of a great little, way to just look at, how do I know if I have an asset that could be in trouble? So if you borrowed on an office building in 2018, right? And let's
Mhm.
say you did a 60% loan to value,
Sure,
the value of your asset is now probably worth the debt.
sure,
So if you're being asked to fund capital calls, you might be just funding preserving the debt, which I know from the lender perspective is great, but you just need to understand those
yeah,
assets, that's their value today. So it's great. The business is always changing. There's always cycles. This is another cycle. We're glad we offer comprehensive services to assist folks, and I think there'll be a real shakeout, as there is in any cycle,
sure.
as we go through this.
And I mean, not to, obviously your clients are confidential and what you tell them is confidential, and I get that, but I imagine a lot of your conversations now are of more of a flavor to say to people, look, we need to look strategically at what's really going on. And even though it may be an unpleasant conversation, because no one wants to be told your building has lost 40% of its value. I mean, no one would enjoy that conversation. You know, Sometimes you got to give people hard truths because, you know, you're the advisor. So,
Yeah, and obviously it's all in how you work collegially and
sure.
respectfully and bring people together. And going through these cycles, you relearn lessons that you learned before. I was thinking, Josh, you had asked me the other day about how would you compare two deals that maybe turned out differently, or one well and one not as well. And
Sure.
I would say what I can share is I have clients, two different investments. One in 2018 locked their debt. The
Hmm.
other client did not. They floated.
Hmm.
That singular investment standard that, would be determined when you acquired it, making a world of difference. So one now is locked at, a 4 plus or minus rate, which would be incredible today. And the other, with the exception of a rate cap, which is, can be expensive, you're floating at a much higher rate. So, there's
And
a
that's it.
there's a lot of conversations, but you know what? You get a good team on it, you collaborate, you address it, you'll move on to the next cycle.
I had an investment as a GP where we had it under contract before COVID happened, and then COVID happened while it was under contract, and the buyer backed out because
Mm.
the buyer freaked out, and reasonably enough, buyer said, "This now I'm now terrified. I am scared. I take my deposit back. I'm going home." And we did eventually get the asset sold, but selling it post COVID, we got less money than we would have gotten pre COVID. And my LP said, "Well, looking back, what should we have done differently?" And I'm like, "Well, put it on the market a month earlier so COVID didn't happen." I mean, that's honestly all I could have said is, hope the contract had gone hard and the guy couldn't have backed out because he couldn't get his. I mean, it was literally a difference of 15 days. Like the money would have been hard, and then maybe we could have made him close because he wouldn't want to lose his deposit. But 15
Josh,
days,
it sounds like to me you couldn't have done much different. You can't,
couldn't
no
do
one can
anything.
refine it, but
But
really congratulations for you that you were able to complete the sale.
well, we got it done eventually, but later on for less money. But I mean that, and but honestly, that was my answer to him. Like, we could have put it on the market 15 days earlier. I don't know. Like, I can't. It's like asking someone, you got hit by lightning, what should you have done differently? Not stand there. I don't know what to say. But
Yeah.
that's the nature of our industry, unfortunately. I always find it amusing that when people have unexpected positive surprises, they always say it's because they were smart and capable. And when they have unexpected negative surprises, it was bad luck. And I'm like, well, nah, it's not always true. Like, like,
No, no, it isn't. And you know what? You hit on something that's just not in anyone's investment committee write-ups or strategy, and that's timing. Timing as a singular item can,
sure,
make all the difference. And so hopefully, folks who are watching this, whether they be GPs or LPs or lenders, they have good team members, good, advisors, good, you know,
sure.
thinking so that they maximize that. But it's, the bell, as one, expression goes, the bell doesn't ring at the top.
Fair
So
enough.
if you get close, that's great.
So last question I have for you, and then I'm good. So one question I've always had. So let's say a GP hypothetically wants to work with pension funds, right? How does a GP find a pension fund, and how do pension funds find GPs? Because you're working in advisory capacity, I get that, but like when a CalSTRS is sitting there, or CalPERS, or any large pension fund, how do they find GPs? How do GPs find them? How does that
Okay.
actually mechanically happen?
So there's a few ways. One, there could be an RFP that the pension fund issues. Okay, so that would be public. Maybe they're looking for fund managers, maybe new separate accounts.
Sure,
That's a great way to get in front of them. You get qualified, they do due diligence on you. They might say, okay, I like Josh Carr's group, I like their track record. So you're in front of them now. Maybe you'll get selected, maybe not, but you're on the radar. That's a great way to get in front of them. The other way, of course, is to cold call. So whether you do it direct or with a consultant, I know there's mixed success in that because people get busy and maybe they want to meet with everybody, but they have limits of time.
sure.
So
Only so
use
many
your
hours in the day.
relationships. It might be, gee, Josh, you could recommend, a GP to be in front of a pension fund or an institution, and they would take the meeting based on that. I'd say this, really listen. It's interesting to me with some of the excitement of GPs of their strategies and their write-ups, really look at them carefully because these these pension funds get hundreds to thousands a day. Everyone says they have the strategy, the return. So just think deeply about it. And when you go to the meeting with the pension fund, think about what they're worried about.
Sure.
Ask them what they're worried about. Just draw them out, and I think that will be so engaging. Whatever the basis is for your visit, it will go very well. Keep at it. You'll eventually start to add investors to your list, and they will start to recommend you to others. But it's really hard work, and I admire the GPs who, over a period of years, build up that investor base.
Honestly, what you're describing to me sounds very similar to the conversations I think any GP has with equity sources. I think whether or not you're doing something at the institutional level or you're rounding up a bunch of small business owners who are going to go in on buying a small multifamily, it always comes back to the fundamentals. It's asking questions, it's communication, it's transparency, it's showing that you have an organization in place, and hopefully having a strategy that works for them,
Yeah.
which is just a matter of talking to enough people.
Right. And their due diligence not only will be about how great of a deal maker you are and the track record you have, it's also going to be, the less exciting part, which is, do you have the organization behind you to administer this? Because setting up a platform is not inexpensive. And
Yeah.
so that's part of the due diligence they will do. And I'm sure the GPs are aware of that, but it's equally important.
Many many years ago, and last comment I'll make is I worked with an entity that was a young REIT. They were going through the public offering process, and they were prior to this privately owned, and their accounting department were really just bookkeepers. And I don't mean to beat up on bookkeepers, but they were bookkeepers, not accountants, and they were doing everything on a cash basis. And the audit firm, which was Ernst and Young, said to them in a very nice way, if you're going to go public, you need 2 years of accrual accounting. It needs to be on a GAAP basis. Like, you need real accounting if you're going public. And the
Right.
most painful thing, honestly, for them to go public was not the road show. It was not the getting the strategy out there. It was just having people rejigger and back up 2 years of accounting activity to show that the numbers were the numbers. And I'm
Yeah.
convinced to this day that the C-level team did not really fully understand why this was an issue. And it's like, well, but you're going to be a public company. Like, you have to have accrual accounting. You have to do GAAP. You're a big boy now. You know, you gotta be an adult. I don't know how else to put it. Um, and that was an amusing early conversation. I won't say who the REIT is because it's one of the biggest REITs in the world now, but it's amusing sometimes where we all start from.
Yeah.
Anyway. Well, look, this has been a pleasure to talk and to go through the somewhat mysterious world of pension funds, because I think a lot of times people on the GP side just see this wall of money and don't really understand how it works. Um, Thank you very much for joining me.
Well, thank you. And my information is on my website. If anyone wants to reach out with my email or phone number, happy to chat, happy to follow up on any questions folks may have. And thank you, Josh, for having me. It's been a great visit.
Thanks again, Erin. See you soon.
Bye.